webcast is now starting. All attendees are in listen-only mode.
Good afternoon, ladies and gents. Welcome to today's webinar. We're going to be chatting about what the hype is about, and it's about the top 50 CoreShares ETF. Thanks to Sean and the team from Easy Equities for hosting us. My name is Chris Rill. I come from CoreShares Asset Management. We manage the ETF in question. Before we kick off, if you can please raise your electronic hands just to let us know if you can hear us clearly, if you can see us, see the screen properly, etc., and then we can kick off. So we are looking like we're seeing a lot of raised hands. And if you have any issues, drop it in the question bar and we'll try and address them. In terms of questions throughout the webinar, please drop a question. We will answer if we think it's the right time to answer, but we'll definitely answer all the questions. I'm going to try to go through this presentation in 10 to 15 minutes, and then it's Q&A. So then it's over to you, and you're more than welcome to ask any questions. I've got a colleague here, MX from CoreShares. We've got Sean from the Easy Equity side. So if you want to ask anything that's ETF or investing related, ask us. If you want to ask anything that's platform related, ask Easy Equities. By the way, guys, I don't know if you heard, but Easy Equities won 2 awards last night at SA Top Stockbrokers. They won the Top Tax-Free Account and the Top Online Stockbroker Award of the Year. So I don't know if you've seen that, but that's a great kudos, and hopefully you're using their services, and that's a nice affirmation that you chose the right partner. So let's chat about what all the hype is all about. I guess we're talking about a lot of awards, but essentially, the hype, when we're talking about the hype, we're talking about an award that the top 50 ETF won earlier this year at the Salter Awards, which is the South African ETF Awards. And it won an award for raising the most capital in the ETF market for local strategies. So the question is, why did it raise the most capital? I mean, it's all good and well that it raised the most money out of any ETF, local ETF in the market, but why did it? So we want to chat about the top 50 ETF because, you know, it's more about what's inside the fund than about just the name itself. Top 50 sounds really simple, but there's actually quite a few smart little rules in this fund which have made it so popular in recent history. So please ask any questions as we go. So the core shares top 50 or C top 50 is obviously an ETF. It trades on the exchange. In other words, it's tradable like any other share through your Easy Equities platform. It's an exchange traded fund. What that means is you buy one security or one share and you get exposure to a portfolio or basket of shares like all ETFs. But essentially, it's very simply South Africa's 50 largest shares in the market. But there's one simple rule, which is a 10% cap. But a little bit of history of how we got to the top 50. I mean, it sounds quite random. You're probably more familiar with the top 40. That's the most widely referenced ETFs and indices. But essentially what happened was S&P Dow Jones, who's our index partner on this particular ETF, came into the South African market around 5 or 6 years ago, and we immediately started doing a lot of work with them. In fact, we were the first ETF provider to partner with them on a number of their products, of course, top 50 being one of them. And when we were looking at a new replacement for a top 40 like strategy, what happened was we really went back to the drawing boards. We said, if it's top 40, well, why is it top 40? You know, why is it not top 42 or top 45 or top 30 or top 60 or top 70, you know? So we did a little bit of work into establishing why it is top 40. At the time, it was top 40 because that's what represented the most of our market. But what we found in 2013, odd, when we started looking at the strategy, was that 50 was more broadly representative of the market. So it was still a very liquid portfolio of shares like the top 40. In fact, it was more liquid because we were further diversified across shares. But we were able to get some of that mid-cap flair by moving from 40 to 50. So we got some of the smaller companies, some of the companies which have more exposure to more growth, which should long-term get you essentially more exposure to higher performing shares. So we decided that perhaps 50 was a more reasonable number than 40. So we went for a portfolio that selected the 50 largest shares. These are free float adjusted. What that means very simply is that if there's a cross holding, take PSG as an example. PSG owns 30% of Capitec. So what we do is, let's say Capitec's total value of the business is 100 billion, but PSG owns 30% of it. In other words, no one can buy that 30%. It's not freely traded. That would be excluded from the free float market cap. So Capitec would essentially get a market cap of 70 billion. So that's the slight adjustment. And then when we were looking at the market, we looked at South Africa and its particular setup and the fact that we had a number of concentration issues in our market. So the one thing that we noticed was that over time, and this is not specific to now, there were single shares or individual shares which could at any point in time make up a very large percentage of your portfolio. So in 2007, 2008, the shares in question were Anglers and BHP Billiton. Those shares combined made up close to 50% of a top 40 portfolio without a cap. So it was a huge amount of exposure, a huge amount of a risk to individual companies. At the point in time when we were looking at it, Naspers was about 13% of the portfolio. So again, a large exposure to an individual share. Now, if you look at it, Naspers is closer to 24%, 22% of the portfolio. So huge single stock risk. So what we thought we'd do is put what we call just simple smart cap of 10% to say we will not hold any share in this portfolio at a greater weight than 10%. And the idea behind it is to diversify your portfolio. The idea behind exchange traded funds is you buy one fund and you get a diversified portfolio of stocks. The other idea behind it is that because we're taking that weight and allocating it across the rest of the portfolio, so in other words, if Naspers would have been 20%, we cap it at 10%. So where does that other 10% go? Well, it goes proportionately across the rest of the portfolio, is that we get slightly more upweight position in some of those smaller shares, which should help our return profiles over long periods of time. So it's a slight tweak on a top 40, but we think it's a really smart way to theoretically improve risk-adjusted performance. So you can see how drastic the improvement on diversification is by moving from a top 40 to a top 50. So not only is it the extra 10 shares, but it's the cap. It's the cap of 10%, which effectively increases your share exposure. Now, what this means, it's a very fancy name, effective share exposure. It means how many shares do you have driving the performance and the risk of your portfolio. So in the top 40, let's use that as an example. Although you have 40 shares in your portfolio, because some of those shares are so small as a weight in the portfolio, they don't even contribute to your return and your risk. In fact, only around 12 shares contribute to your risk and return dynamics in your top 40 portfolio. A simple way of looking at it would be to say, well, how would I get the most diverse portfolio at an effective share level? And it would be to equally weight your top 40. So if you have each share with equal weights, your effective share exposure would be 40. Now, what's interesting is by putting one simple cap in, we almost double the effective share exposure. In other words, we almost double the diversification of the portfolio by having that cap at 10%. And how is that done? Well, it's done by saying the extra 10% that we would have allocated to Naspers, we're now allocating to the rest of the portfolio. So those shares where we're making allocations to have a more considerable influence on performance and risk over long periods of time. So we can see the impact of capping. It's fantastic, and diversification. But surely we're diversifying away our returns here. Surely with a share like Naspers that's performed so well, if we've been cutting it back, are we diversifying away our returns? And that may be a reasonable conclusion, but what we find when we look at the results is that, in fact, no, we're not. In fact, we're improving returns for two reasons. The first is that the only free lunch in investing, as explained by one of the, let's call him godfathers of investing, Harry Markowitz, is that diversification is the only free lunch. And by allocating further down the tail of the index, we get more exposure to smaller, more growth-oriented companies. So although Naspers has been the darling of the exchange in recent history, by holding back on that exposure, we've actually improved returns over 1, 3, 5, 7, and 10 years. This is the index, by the way, just to disclaim, this is not the actual ETF, but it's compared to the top 40 index, which doesn't cap Naspers. In other words, the top 40 index in red is the index that has a full allocation. In other words, has only has very few shares driving the performance. What's even more noticeable is perhaps the standard deviation, and this is probably more expected, that by capping it out, by creating a more diversified portfolio, we have lower standard deviation in the top 50 capped portfolio than in the top 40. So we've improved returns, we've improved risk as measured by standard deviation. And what we've improved here, which is a measure that a lot of professional fund buyers use, is the Sharpe ratio. Sharpe ratio is a fancy way of saying how much return do we get per unit of risk. So by capping, we actually improve the risk-adjusted returns, or the percentages of return that we get in excess of the risk-free rate divided by the units of risk that we have within the portfolio. So on all measures, in fact, although our 10% cap was essentially a rule to improve diversification of what we thought was a concentrated starting point, we had an impact of improving returns, which can be explained by having more mid-cap exposure, and by diversifying away single stock exposure, we improve risk. So an improved risk-adjusted return on the entire portfolio. And this really is what all the hype is about. This is why investors have started making these investments. There's a lot of talk in the media, in investment circles, I'm sure around bright places, that how can you hold a portfolio that has 20 to 30% investment in one share? If that share goes down, like in a similar example, we've seen a number of corporate failures recently. We've seen Steinhoff, we've seen EOH, to a lesser extent, we've seen MTN and Aspen. So we've seen a lot of corporate failures. What if the next corporate failure is Naspers? How can your portfolio hold such a high portion of it? So we think that a lot of the reason why investors are choosing a top 50 and our top 50 ETF over the top 40 is because of that diversification benefit, because you're getting the extra 10 shares and you're capping and you're reducing your risk to any single share, not just Naspers, any share that happens to be greater than 10%. So this share, this ETF, the share code is CTOP50. NAV per unit is around 23 Rand. It's benchmarked to the S&P 50 index, which is this index which we track, and I'll show you how good the tracking has been in the next few slides. And the real important rule here is the weighting method, where we've capped the single largest share to 10%. So no share can hold an exposure of greater than 10%. We've raised around 900 million rand in this portfolio. That's in about 3.5 years. But really, when the real money was raised was last year. We raised about 600 million rand in this portfolio. And this was as that Naspers problem in the market was becoming more and more highlighted, more and more of the risk. We actually go and buy and hold those underlying shares. So that's what physical replication means. And I suppose the important number for you as investors is the TER, and the TER is 0.26%. So it's not the cheapest ETF in the market, but we think that the 10% capping rule and some of the smart tweaks to what's just a standard top 40 is what's really given us an advantage relative to some of the other, let's call them broad and large ETFs in our market. So I've shown you the index, and that's all great. That's the theory. But how's the ETF done? And you'll see the ETF has done pretty much exactly in line with the index since inception, 5.13% for the annualized number for the ETF versus 5.06%. 3-year numbers looking a bit better, 2 years and 1 year. And what you'll see is that you're buying a very tightly tracking fund. In fact, when you look at this line graph, you actually can't see a difference between the ETF and the underlying index. So, you know, that theory that we were hoping to execute has actually come through in reality. And I think that's the important part of this slide. To give you an idea of how large the impact is, we've just pulled the top 10 shares in each of the ETFs or in each of the indices and I guess in turn the ETFs. This is as of today. So one of the beauties of ETFs is you can pull the weights of the shares in that ETF at any point in time. And what you'll see is that significant impact of capping out Naspers at 10%. So in a top 40, which is uncapped, we get Naspers at around 22-23% of our portfolio. In this particular portfolio, it's obviously capped at 10%, so it's sitting at around 10.26%. The reason why it's above 10% is because once a quarter, we go and cap it at 10% and make sure that it's back down to 10%. But within the quarter, it may increase to 11%, it may actually drop down to 9%. It depends on the weight of that particular security. So the capping drifts intra-quarter, and what you'll see is that the spread across the top, say, 4 shares is far more even than in the top 40 construct. And this is really the goal of the ETF, is to diversify away that single stock risk to get a portfolio of shares so you're well diversified. This is just a very simple recap. What the top 50 ETF does is it buys the 50 largest shares. It caps the largest share at 10%. We think it's a more diversified portfolio, and it gives you more return potential, and that can come through in the numbers. But the real question, if this is so simple, if we're just selecting the 50 largest shares in the market and capping it at 10%, I mean, what are these guys at CoreShares on about? Because surely I can just go and select a few shares and outperform this. And this is the startling number. This is a statistic of professional fund managers. So this is managers who are all the smart guys in the room. They're the actuaries, the CFAs, the CAs, etc. And this is the probability of them outperforming a very simple index like the top 50 index. And what you'll see is that over a 5-year period, 93.23% of fund managers, of professional fund managers, will actually outperform a very simple strategy like this. Underperform a very simple strategy like this. So the question you have to ask yourself as an investor is, can you actually outperform a very cost-efficient, simple strategy like the top 50? Now, we actually don't discourage you as investors from buying single stocks. That's probably why you're on easy equities. And in fact, our brand, CoreShares, talks to a strategy of investing known as Core Satellite, where we believe you should be holding the core of your portfolio in ETFs. So hold the top 50 as 60-70% of your portfolio, and then perhaps make your stock picks around that. But certainly by holding an ETF at the core of your portfolio, you increase the chance of you having a successful investing experience, and you reduce your risk to any single share. So that's it on the top 50 stuff. There's a disclaimer all about us. But if you've got any questions, I can see we've already got one question that's come out. Please shout. and we will get to them. We, as promised, try to keep this as short as possible, so 15, 20 minutes. And it's all about Q&A now, so please fire away if you have any questions, either for Sean from an Easy Equities perspective or from myself or MX from a CoreShares perspective. The recording, Sean will record it, and he's going to put it onto their YouTube channel, and he'll probably tweet it. We'll tweet it as well and put it out there, but there is absolutely a recording. Please feel free to share it with friends, family, etc. This is an open source educational webinar, so please don't hesitate to share the webinar. So if there are any questions, please fire away. That's it for now. It's usually we'll sit around here for 5 minutes or so. We can sit here for an hour if you've got the questions, but if there are no questions after 5 minutes or so, then we'll probably wrap the webinar. MX, I don't know if you want to add anything. I missed out on anything important. Sean was going to say an acceptance speech for the Top Stockbrokers Awards, but he's bowing out now. So please fire away if there are any questions. I mean, for me, what's really amazing is how the professional fund managers struggle to beat a really simple index like this. And the fact is, interestingly, we've got also in the unit trust market. It's the cheapest unit trust in the market, and it is always ranked amongst the best performing unit trusts, who charge between 1.5% and 2%. What is the bit confused? Is there a difference between an ETF and an index? So perhaps I should have been clearer. The index is the theoretical portfolio. In other words, that is the portfolio calculated by S&P Dow Jones. The index will then be shared with us as CoreShares. In fact, this was an index that we worked on together. They'll send us an index file which will say, CoreShares, you need to go in your portfolio and own these shares in this proportion. So you need to go and buy, if your portfolio is 100 million Rand, you need to go and buy 10.67 million Rand of BHP Billiton, 10.26 million Rand worth of Naspers, etc., etc. So we'll actually go and buy that physical shares. We'll hold those physical shares as underlying in your portfolio. So every ETF is backed by the physical shares. If you remember earlier in the presentation, I spoke about physical replication. That basically means that our portfolio, we hold the actual ETFs. And then we try and track this index as closely as possible. So the measure for you to see how well we've done as CoreShares when trying to deliver you the theoretical portfolio is to look at our actual portfolio. So the ETF is the blue, and the index is the red, and you'll see how close we get to the actual index. In fact, there are periods where we've slightly outperformed the index due to efficiencies that our portfolio management team have managed to eke out. So there is a difference between the index and the ETF, but the ETF and the index should look identical. The ETF is what you as an investor can actually go and buy and hold in your portfolio. So CTOP 50 is the ETF that you can hold. It's an access point to the strategy of CTOP 50. I've got another question. I'm going to put it over to Sean. It says, what are the costs of this ETF within Easy Equities? Is there a difference if I don't invest through the Easy Equities platform? So the costs of the ETF don't change if you're buying it through the actual fee that I spoke about, 0.26%. They don't change. I will let Sean answer the cost of what the actual ETF is to trade through the platform. But I believe it's 25 basis points and zero administration fees. Yeah, exactly. So your cost for every 100 Rand of this ETF you'll buy to Easy Equities is 25 cents. And that's a once-off cost. So you don't pay that as an ongoing. Remember, if you don't buy it through Easy Equities, you have to buy it through another stockbroker because it's an ETF. It trades on the JSE. So there's no getting around that brokerage costs. I know Easy Equities, their key differentiator is that they cost leaders. So in other words, they are, as far as I know, the cheapest costs. And you have to be careful with the T's and C's. Some guys might have a cheaper brokerage cost. So they might be, let's say 0.15%, but they'll have an ongoing fee of, let's say, a fixed fee, either 50 Rand a month or 0.5%. So you've got to really try and understand, what the total cost is. How would CoreShares top 40 equally weighted compare to the top 50 capped? So it's quite a different portfolio. This is what we would call the modified market cap weighted portfolio, whereas top 40 equally weighted is completely agnostic of the cap weighted portfolio. It gives each share equally weighted and equal contribution. So, 40 shares, you're getting 2.5% essentially per share. What you get is if you remember the slide, in terms of the share exposure of 20, you get exposure to 40 shares in the top 40 equally weighted. But what's happened is, because the exposure is very tilted towards South African incorporated, more smaller mid-cap shares in the top 40, because that's where your weight sits, you actually have underperformed the top 50 over the last, over most of these periods. So what you have to understand when you're buying the top 40 is it's primarily driven through a risk appetite. In other words, you don't want to take on any exposure, or you want to take on the least possible exposure to individual shares, and that's why you're equally weighted, as opposed to trying to blend a risk and return dynamic. Top 40 is a great methodology, but a lot of people struggle to understand why the returns could be so different to the top 40, and they really are so different. You're getting a very different portfolio. How long would you start seeing returns and dividends? So this portfolio distributes quarterly. So it depends when you buy it, but if you bought it, the longest that you would have to wait for dividends is about 3 months. If you bought it now, we pay out a dividend for the end of September, so you'd be getting it relatively soon. So yeah, dividends are paid out quarterly to investors. Okay, I think we've got some more questions. Okay. I mean, anecdotally, part of our business is to provide exchange traded funds. Another part of our business is to provide unit trusts. And the unit trusts are typically bought by advisors or multi-managers who are more institutional. Now, that fund has also grown significantly in recent history. We've taken on about 500 million Rand this year. And the reason why guys are buying it is because it's not a massive variation from the market. In other words, all the theory behind just buying simple market cap weighted is still in place. But because of the cap, you get a much more diversified portfolio. So it's kind of a best of both worlds, if you will, that you can get exposure, simple exposure, low cost exposure to the market, but you can diversify away some of that risk, some of that Naspers risk, which sits in a full weighting in a market cap weighted top 40. Questions have dried up a bit, so if we are not talking, we're waiting for more questions, so please fire away. It also, if you've got any questions on the platform or on any of our other ETFs, please fire away. We are here to answer any questions. It doesn't have to be relating to the top 50. Guys, that's a wrap. If you've got any other questions, don't hesitate to drop us an email at info@coreshares.co.za. You can also drop the guys Easy Equities a line. That'll help me. Lesejo, could you drop us an email at info@coreshares? It seems like more of a personal question. I would prefer not to air it over the line. and we will get back to you as relates to your tax-free savings account. So it's info@coreshares.co.za. But thanks everyone for joining us. We really appreciate you guys taking time out of your day and chatting to us and asking us questions. We will be doing some more webinars with Easy Equities. Their questions, how long until new listings? Don't worry, we'll let you know as soon as we've got things in the pipeline. But there are 75 ETFs on the market. So, there's a lot of homework to get your head around all of the different products out there as it stands. We're trying to keep things as succinct and simple and as exciting as possible. So we will bring new products and we'll be sure to let you know. But from CoreShares side, thanks so much for tuning in, and thanks again to Sean and the Easy Equities team for hosting us today. As I said, we're going to be doing some more webinars, and feel free to share these, etc.